Series 6 Exam Masterclass, Part 1 Introduction, 2 minutes. Hello and welcome to this Series 6 exam crash course. My goal is to walk you through everything you need to know to pass the FINRA Series 6 exam, step by step, in a clear, engaging way. Whether you're just starting out or reviewing before test day, this session will give you the confidence and knowledge to succeed. Let's start by discussing what the Series 6 exam is, what it allows you to do, and how the test is structured. Section 1. What is the Series 6? 3 minutes. The Series 6 exam qualifies you to become a registered representative, specifically an investment company and variable contracts products representative. This means you can sell mutual funds, variable annuity unit investment trusts, UITs, municipal fund securities, like 529 plans. You cannot sell individual stocks or bonds, direct participation programs, DPPs, options. So, remember, Series 6 is about packaged investment products, not individual securities. Section 2. Exam structure and strategy. 5 minutes. The Series 6 exam consists of 50 scored multiple choice questions, 5 unscored experimental questions, randomly placed, 90 minutes to complete the exam. Passing score 70%, 35 correct answers out of 50. The questions are divided into 4 major job functions. Seeks business for the broker-dealer from customers and potential customers, 12 questions, 24%. Opens accounts after obtaining and evaluating customers' financial profile and investment objectives, 8 questions, 16%. Provides customers with information about investments, makes suitable recommendations, transfers assets, and maintains appropriate records, 25 questions, 50%. Obtains and verifies customers' purchase and sale instructions, processes, completes, and confirms transactions, 5 questions, 10%. Test-taking tips. Read every question carefully, watch for words like except, not, or least likely. Eliminate obviously wrong answers first. If you're unsure, make your best guess and move on, don't leave anything blank. Section 3. Investment company products, mutual funds, UITs, and closed-end funds, 20 minutes. Let's dive into the heart of the Series 6, investment company products. 3.1 What is an investment company? An investment company pools money from many investors to buy a diversified portfolio of securities. The 3 main types are open-end investment companies, mutual funds, closed-end investment companies, unit investment trusts, UITs. 3.1.1 Mutual funds, open-end funds, continuous offering. Mutual funds continuously issue new shares and redeem existing shares at net asset value, NAV. Pricing. Shares are bought and sold at the next calculated NAV, forward pricing, typically at 4 p.m. Eastern Time. Diversification. By law, mutual funds must be diversified. Professional management. Managed by a fund manager. Liquidity. Shares can be redeemed at any time at NAV, minus any applicable charges. Key terms. NAV, net asset value. The per share value of the fund's assets minus liabilities, divided by shares outstanding. Sales charge, load, the fee paid to buy, front-end load, or sell, back-end load, mutual fund shares. 12b1 fee. Annual marketing or distribution fee, expressed as a percentage of assets. Example calculation. If a fund has $100 million in assets, $2 million in liabilities, and 10 million shares outstanding, NAV equals $100 million, $2 million, 10 million equals $9.80 per share. Types of mutual fund share classes. Class A. Front-end sales charge, lower 12b1 fees. Class B. Back-end sales charge, contingent deferred sales charge, or CDSC, higher 12b1 fees. Convert to Class A after a period. Class C. Level load, annual sales charge, highest 12b1 fees, no front or back-end load. Breakpoints. Discounts on sales charges for large investments in Class A shares. Always disclose breakpoints to clients. Rights of accumulation. Allows investors to combine purchases to qualify for breakpoints. Letter of intent, LOI. Written statement that the investor intends to invest enough over 13 months to qualify for a breakpoint. 3.1.2 Closed-end fund single offering. Issue a fixed number of shares through an IPO. Exchange traded. Shares trade on secondary markets like stocks. Pricing. Priced by supply and demand, may trade at a premium or discount to NAV. No redemption. Investors sell shares to other investors, not back to the fund. 3.1.3 Unit investment trusts, UITs, fixed portfolio. Invest in a fixed set of securities, no active management. Redeemable units. Investors can redeem units at NAV. Terminated at maturity. UITs have a set maturity date, at which point proceeds are paid to investors. 3.1.4 Comparing investment companies feature mutual funds closed-end funds UITs shares issued continuous one-time IPO trading fund, NAV, exchange fund, NAV, management active passive redemption yes, NAV. No, secondary, yes. NAV. 3.2 Mutual fund features and benefits diversification. Reduces risk by investing in many securities. Professional management. Fund managers make investment decisions. Liquidity. Shares can be redeemed at any time. Automatic reinvestment. Dividends and capital gains can be automatically reinvested. Convenience. Easy to buy and sell, low minimums. Transparency. Daily pricing, regular statements. 3.3 Mutual fund fees and expenses sales charges, loads, compensation for selling the fund. Front-end load. Paid when you buy. Back-end load, CDSC, paid when you sell. No load. No sales charge, but may still have 12B1 fees. 12B1 fees. Annual marketing, distribution fee, max 1%. Management fees. Paid to the fund manager. Other expenses. Custodial, legal, accounting, etc. Expense ratio. Total annual fund operating expenses, average net assets. 3.4 Types of mutual fund stock, equity, funds. Invest in stocks, growth, value, sector, index, etc. Bond. Fixed income, funds. Invest in bonds, government, municipal, corporate. Balanced funds. Mix of stocks and bonds. Money market funds. Invest in short-term, high-quality debt. Very safe, low yield. Target date funds. Asset mix automatically shifts as target retirement date approaches. 3.5 Mutual fund distributions and taxation dividends. Paid from income earned by the fund, taxed as ordinary income. Capital gains. Paid from profits on sales of securities, taxed as capital gains. Reinvestment. Dividends and gains can be reinvested, but are still taxable. 3.6 Suitability considerations. Time horizon. Longer equals more aggressive funds, stocks, shorter equals conservative, bonds, money market. Risk tolerance. Conservative, moderate, aggressive. Investment objective. Growth, income, preservation of capital. Example suitability question. A 65-year-old retiree wants to preserve capital and receive income. Which fund is most suitable? Correct answer. Bond or money market fund. Section 4. Variable contracts, variable annuities and variable life insurance, 10 minutes. 4.1 What is a variable annuity? A variable annuity is an insurance contract that allows the owner to invest in a selection of sub-accounts, similar to mutual funds. The value of the contract fluctuates with the performance of these investments. Phases. Accumulation phase. Investor makes contributions, which are invested in sub-accounts. Annuitization phase. Payouts begin, either for life or a set period. Features. Tax-deferred growth death benefit. Beneficiary receives at least the amount invested, minus withdrawals, optional living benefits, guaranteed minimum withdrawal, income, or accumulation benefits, surrender charges for early withdrawal, typically 7-10 years, declining over time, suitability. Long-term investment horizon, seeking tax-deferred growth, comfortable with investment risk. 4.2 Variable life insurance, combines life insurance with investment options. Premiums are fixed, but cash value and death benefit can vary based on investment performance. Policyholder chooses how cash value is invested. 4.3 Regulation of variable products considered securities must be sold by registered representatives with Series 6 or 7 in insurance license. Prospectus delivery required before or at time of sale. FINRA Rule 2330, Special Suitability and Supervision for Deferred Variable Annuities. Section 5. Review and practice questions, 5 minutes. Let's review with a few practice questions. Question 1. Which type of investment company continuously issues new shares and redeems shares at NAV? A. Closed-end fund. B. Mutual fund. C. UITD, hedge fund. Correct answer. B. Mutual fund. Question 2. A client wants to invest $100,000 in a mutual fund with breakpoints. What should you do? A. Ignore breakpoints. B. Explain breakpoints and help the client qualify. C. Recommend Class B shares. D. Charge the maximum sales load. Correct answer. B. Explain breakpoints and help the client qualify. Question 3. What is the primary benefit of a variable annuity? A. Guaranteed fixed return. B. Tax-deferred growth. C. No investment risk. D. Immediate liquidity. Correct answer. B. Tax-deferred growth. Closing for Part 1 concludes Part 1 of our Series 6 crash course. We've covered the exam structure, investment company products, mutual funds, UITs, closed-end funds, variable annuities, and basic suitability. In the next part, we'll dive deeper into regulations, client accounts, suitability, and test-taking strategies.